People rush to withdraw their money. Fear spreads faster than facts in finance.
Imagine you want to buy a toy house, but you don't have enough money.
Someone still gives you the interview. That's how the millions are friends you can pay later.
Suddenly, everyone wanted houses. Prices started going higher and higher every year. That believed price was a big mistake. When prices go up fast, people feel rich. They start borrowing even more money, thinking profits are guaranteed. But fast growth can hide danger underneath. Banks stopped being careful. They gave loans without checking if people could repay them. More loans meant more profit for banks, so they ignored the danger. Banks didn't keep these loans themselves. They bundled many loans together into packages. Then they sold those packages to investors. It looked safe, but it wasn't. Investors trusted these packages. They believed the loans were safe investments. Experts even gave them high ratings, but the reality was very different. Then people started losing jobs. Without income, they couldn't pay their loans anymore. Missed payments began increasing everywhere. The system started cracking. Because loans were connected together, one failure affected others, like dominoes falling in a line. Problems spread quickly across banks and investors. Fear started growing. House prices suddenly dropped. Homes were now worth less than the loans people owed. People stopped paying completely.
The financial crisis exploded worldwide.
Banks started losing huge amounts of money. People realized the system wasn't safe anymore. People rushed to withdraw their money. Fear spreads faster than facts in finance. Some massive banks actually failed. That shocked the entire world. The crisis spread across countries quickly. Money systems are globally connected. Millions of people lost jobs. Families struggled to survive. Governments stepped in with emergency money. This was called a bailout.
Why help the banks?
What about us?
We feared total collapse.
The bailout stabilized the system slowly, but trust was damaged badly. Recovery took many years. Economic wounds don't heal quickly. The crisis taught powerful lessons. Debt can become dangerous fast. Borrowing isn't bad alone. Too much borrowing creates risk. Savings act like protection. They help during hard times. Putting money in many places reduces risk. Diversification protects investors. Fast profits often hide danger. Slow growth is usually safer. Warning signs existed before the crash, but greed made people ignore them. Greed pushes people to take risks. Logic disappears during bubbles. Fear replaces greed after crashes. Markets move on emotions. Experts misjudged risk levels. Ratings were not always reliable. Too much leverage increases danger. Small problems become huge quickly. Bubbles grow when prices detach from reality. Eventually, they burst. People copy others during booms. Herd behavior creates bubbles. Risk management is essential. Ignoring risk destroys wealth. Long-term investing is safer. Time reduces volatility impact. Real value matters more than hype. Speculation can collapse suddenly. Financial education protects people. Knowledge reduces mistakes. Emotions cause bad money decisions. Discipline creates better outcomes. Debt can trap people financially. Freedom requires control over borrowing. Housing prices don't always rise. Markets move in cycles. Regulations increased after the crisis. Systems tried to become safer. Banks improved risk controls later. Lessons were slowly applied. Personal finance rules became clearer. Spend less than you earn. Save before you spend. Avoid hype-driven investments. If it looks too good, it is risky. Crashes create opportunities too. Smart investors buy during fear. Some people became richer during the crisis. Preparation makes the difference. Mindset matters in markets. Calm decisions beat panic. Economies rebuild over time. Growth always returns eventually. Markets move in cycles. Downturns are temporary. Strong foundations prevent collapse. Financial stability starts with basics. Another crisis can happen anytime. History often repeats. Money systems look strong but are fragile. Understanding them protects your future.